Hello, everyone, and welcome to the BP Learning Channel. Today, we're here to talk about value again. Only this time, we are going to talk about the holding tank of value, the balance sheet, a very important financial report that very few business owners understand. And yet, it's the first place bankers and investors go to see what kind of ownership stake an entrepreneur has in the business and what kind of preliminary value the business might have. I'm Debbie, a certified SBDC coach at the Business Incubator. The Incubator is a partner with the Colorado Small Business Development Center under the SBA. I'm also a former business owner myself, a former CFO for multiple startup ventures in the Silicon Valley, and a CPA with a master's in finance. That's me, folks, and I'm here today to help you unravel the mystery of the balance sheet, the holding tank for value. First, let's try to make some sense out of what the term balance sheet actually means. Let's take the mystery out of these words. Let me start by saying the balance sheet is the foundation of value in a business. In fact, I like to call it a net worth statement, another term often used by experts in the financial world. In both cases, some simple math needs to be done. Let's take a look at the math. It begins with what you own. Assets. In this case, $581,860. Then you subtract what you owe. Liabilities. $506,372. And that gives you a preliminary valuation. It equals what's called equity. In this case, $75,488. Some businesses sell based on net asset value, similar to net worth. But you need a clean set of books to maximize this value. You'll hear me say this every once in a while. It's important. Clean books. Net asset value equals net worth. Let's examine this holding tank of value now. Assets, liabilities, and equity are all held in this tank in various proportions at a specific point in time. But what exactly does this mean? What are these three items of value in the value tank? We'll talk about assets first. Property owned by a company that has economic value, either tangible, something physical that you can touch, such as furniture and equipment, or intangible, something non-physical, such as a patent, a brand, a trademark, or a copyright. All of these assets have economic value. Liabilities, on the other hand, are obligations of a business to transfer an economic resource to an entity or a person as a result of past events. In simple terms, money, product, or services due in the future to someone. Debt. Equity is the net amount of funds invested in a business by its owners, plus any retained earnings in the business. You want the scale to be asset heavy. You own assets more than you owe liabilities. Remember, assets minus liabilities equals equity or net worth, or my favorite word, value. Big picture. The two major components of equity or value are assets and liabilities. These components change continuously as the business strives to thrive and grow. These elements are classified in two major categories: current and long-term. Classifications which help performance monitoring in terms of short-term viability or liquidity and long-term sustainability. Let's spend a moment or two and talk about what this means. Short-term viability. Current means anything less than 1 year. The current classification is all about liquidity, a company's ability to convert assets to cash or acquire cash via a loan or money in the bank to pay its short-term liabilities. Bottom line, it's all about paying your bills. Long-term sustainability. Long-term means greater than 1 year. The long-term classification is all about sustainability, a company's ability to earn revenue or get a return on investment that covers expenses and makes a profit over the long haul. Bottom line, the business needs to thrive and grow. It needs to have long-term sustainability. Equity accounts are probably the least understood accounts on the balance sheet and the most abused accounts. Yet, this group of accounts reflects important information about ownership and value of the company. Let's talk about how these accounts should work. It's really pretty simple. Then we will talk about how they are often misused. Equity accounts present ownership and value information. Equity accounts have three basic elements which vary a bit based upon the type of legal entity selected for the business. The first element is capital contributions. This amount represents the total amount of money owners have personally invested in the business. This money is generally not returned to the owners until the business is sold. A C corporation or an S corporation has two accounts: capital stock and additional paid-in capital, which collectively represent contributions or money invested by owners. The second element is retained earnings. This represents the cumulative net earnings or loss, or profits or loss of a company available for dividends or distributions. This element includes current year net income or loss, which is presented separately during the year in the equity section of the balance sheet. At the end of the year, net income is rolled into retained earnings. The third element is dividends or distributions. These are withdrawals from the company. This represents the sum of money paid by the company periodically to owners out of profits. Amounts not distributed to owners are often retained for reinvestment into the business or perhaps for contingency reserves. Importantly, dividends should only be paid if there are surplus profits available. Paying anything more may have negative consequences for tax and for value purposes. I mentioned earlier that these accounts are often misused, maybe even abused, and they are, usually not intentionally, so I have learned over time. It just never, ever crossed my mind that a business owner might not know. Capital contributions are an investment in the business, and investments like this are a long-term commitment. Skin in the game, bankers and potential investors like to say. You don't get to take it out of the business when you can't pay your bills next week. Dividends and distributions should only be paid from profits in surplus. You don't simply pay yourself a dividend whenever you need the cash. Shareholder loans must be paid back, and interest must be paid on these loans. Moreover, it's debt on the balance sheet. It's not an equity account. And yet, over and over again, these accounts are misused. Accounts are filled with personal transactions and sometimes treated as loans that often the company can never pay back. And it's all about money that owners need to pay their bills, even if there aren't any profits. Bottom line, if there's not enough money to pay yourself on a regular basis, then stop. Something is terribly wrong. Figure it out before your business falls apart. Back to the basics again. What you own minus what you owe equals value. The value equation. Let's take a look at the holding tank now under 3 different scenarios. In each case, we will use the basic equation assets minus liabilities. In the first case, we have assets of $100,000 minus liabilities of $99,000. This results in a value of $1,000. Notice, the tank is only 1% full. 1,000 divided by 100,000. Value is low in this case. In case 2, we have $100,000 of assets minus liabilities of $50,000. This results in a value of $50,000. Notice, the tank is now half full, or 50%. 50,000 divided by 100,000. Value is acceptable. Maybe. It depends upon the industry and the owner's expectations. In case 3, we have assets of $100,000 minus liabilities of $10,000. This results in a value of $90,000. Notice, the tank is now 90% full. 90,000 divided by 100,000. Value is high, probably under any circumstances. The goal is to keep that river of value, net income, flowing so the tank never ever gets too low. As a reminder, this means revenue must be greater than expenses on a steady state basis. Look, I know this finance stuff isn't much fun for a lot of business owners. I know you're busy doing the things you love, making your business run. But I also know that if you don't understand some of this basic finance stuff, if you just leave it up to somebody else, like your tax accountant, your business may never, ever thrive and grow. We are talking about value here. Maybe the biggest investment you ever make in your life, your business, maybe your livelihood, and maybe your retirement money. So, hang in there with me and understand what your business is all about when it comes to value, when it comes to making money and growing this thing you love. The balance sheet, the foundation of value. Okay, we are finally looking at an actual balance sheet, one for Rockcastle Construction, a report that presents the basics we've been talking about today, starting with what you own, assets. I put a green bracket around the assets because assets represent value available in a business to owners. Note, the first assets are current assets or short-term assets less than 1 year old, the ones that help a company measure liquidity or short-term viability. Assets like checking and savings accounts, accounts receivable, and inventory. Next are long-term assets, the ones that help a company measure sustainability, a company's ability to survive over the long haul. Assets like fixed assets, which include furniture and equipment, vehicles, buildings, construction equipment. Collectively, these assets are the backbone of the company. They help the business generate revenue and profit. A total of $581,860. I have summarized what this business owns off to the right so we can look at some key performance indicators, or KPIs. In this business, current assets of roughly $114,000 represents 20% of total assets. Long-term assets of $468,000 are roughly 80% of total assets, with building and improvements representing the bulk of short-term and long-term assets. A common measure used for current assets is the liquidity ratio. Current assets divided by current liabilities. The ratio measures a company's ability to cover its short-term obligations with its current assets. As a rule, most companies aim for a liquidity ratio above 1.0. This means assets are greater than liabilities. A good ratio is 1.5 to 3.0. This company has a good ratio, 2.3. A common measure for total assets is return on assets, or ROA. Net income plus interest expense net of tax divided by total average assets. The ROA ratio measures how profitable a company's assets are in generating profit or net income. ROAs over 5% are generally considered good. This company has an ROA of 3%, not a very good ROA. And next, let's look at What you owe. Liabilities. I put a bracket around these liabilities because liabilities reduce a company's value. Note, the first liabilities presented are, again, current liabilities, less than 1 year old. Liabilities like accounts payable, credit cards, payroll, and sales tax. Again, part of the liquidity or short-term viability measurement we just reviewed. Long-term liabilities help a company measure sustainability, the ability to survive over the long haul. Liabilities like loans for vehicles, for equipment, for furniture, and for a mortgage on the building. As you can see off to the right, current liabilities represent 10% of total liabilities, while long-term liabilities represent 90%. A very important sustainability KPI is the debt ratio. Total liabilities divided by total assets. As a general rule, most companies aim for a debt ratio of no more than 50%. That is, liabilities are no more than 50% of assets. A debt ratio between 30 to 36% is generally considered good. This company has a ratio of 87%. Now that's pretty high. Next, let's look at net worth or equity, the preliminary value of a company. I put a green bracket around the equity accounts because this net number potentially represents the amount of money that would be returned to owners if all of the assets were liquidated and all of the company's debt was paid off at the date of the balance sheet. Hopefully, this is a positive number. Otherwise, there is no money for business owners. Let's study the three components of equity we talked about earlier today. Let's start with the first element, capital contributions. This is money contributed by owners, money that is only returned if the business liquidates or is sold at a positive value. In this case, the company is a corporation, so you see stock of $500 and paid in capital of $38,774. Collectively, the $39,274 is considered contributions. The second element is dividends, sometimes called distributions. This is a negative number because it represents money withdrawn from the business. Owners are receiving all or a portion of the business profits. In this case, $6,700. Value is being withdrawn. The third element is retained earnings. This number represents net income or loss or profit or loss earned over the years. Retained earnings is presented on the balance sheet on two separate lines in the equity section. Retained earnings, which represents cumulative profit or loss, and net income, the current year profit or loss. In this case, you can see $25,170 and $17,744, collectively $42,914 for a total retained earnings. When you add the three components here together, you get total equity of $75,488. So, What does this number mean? Is it good or is it bad? Well, we have another important KPI to help us answer this question. It's called the equity ratio. This ratio presents equity as a percentage of total assets. Equity divided by total assets, excluding intangible ones. In this case, 75,488 divided by 581,860, resulting in a ratio of 13%. As a general rule, most companies aim for at least 50%. That equity is at least 50% of total assets. The higher the percentage, the better. Companies in the 20 to 40% range are considered highly leveraged. A whole lot of debt, generally not a very good thing. 13% is a very highly leveraged company. And that's the balance sheet, the holding tank of value. Okay, we've been talking a lot about value today. Business in general is all about value. Bottom line, investors invest to make money. And you are an investor when you own a business. So, when you think about value, what do you want? What do investors want? Bottom line, investors invest to make money. They want a strong profitability river flowing downstream on a continuous basis. That's the income statement. And they want a holding tank full of value, assets greater than liabilities, and a positive equity balance. That's the balance sheet. At the end of the day, one way or another, it's all about value. So, if you have been one of those many business owners who have shied away from a balance sheet report because it's scary, or maybe too confusing, I hope that you now understand a balance sheet is merely a holding tank of value. It's what you own after all of your debt has been paid. It's what you can sell at the end of the day, what you can liquidate if that's what you want or need to do. And that's why it's the very first place bankers and potential investors go. They want to see what kind of ownership stake an owner has in the business and what kind of value the business might have. They want to benchmark the items in this value tank and assess the net worth of the business going forward. And that's it, folks. What you own minus what you owe equals value. That's all a balance sheet really is. Think value as you leave this session today. But before you go, take a look at all the strategic learning tools available for free on my website. Projection models and finance keeping templates to help you maintain a good set of management books and focus on business performance. And please, subscribe to the BP Learning channel so you don't miss out on other prosperity tips that might be helpful. Thanks for listening, folks. I'll see you the next time.